Hi, everybody. Alexander, Sinatra, Hugo, how's everyone doing today? Let's all be patient and have a good week. Give me a why if you're going to be patient this week and let things come to you and not be afraid of missing something, because it's okay to miss things. I miss trades every day. You know why it's okay? There'll always be another one coming around the corner. So relax, everybody. I want to start with the dollar. Everyone see my screen, see the dollar there? I'm looking at the 2 hour. Give me a why if you can. Pretty sure everyone can. All right. Hello, Chi Meng. How are you? Welcome to Face. So we keep knocking against this resistance here at about 93.5, trying to come off a little bit here. Like I said, I don't think this tick is for real. So far we haven't made a new high right here. And what I'd like to see for it to be a third drive is a new high. And then give me a reversal signature, reversal candle afterwards. Otherwise, if it's a breakout and we start closing above here, then what you do, if you're a dollar bear, is you wait for it to close back underneath this wall that the dollar keeps knocking its head against. Everyone with me? Hello, Diosthenes. Monica, how are you? All right. So, I usually don't like to fade the dollar when euro is weaker than cable. It's trying to hold last week's lows. I mean, it's not the worst shot if you try it down here and risk 50. Maybe we're going to try one more low here. Yen is still marching. Way overdone. I can't reach for it. Eventually now after this type of breakout move, I think that we're headed for this upper channel, which would be a 3 drive up here at 1243. It shows up a little better on the weekly where you could see 3 drives developing. See, here's 1, here's 2, here's 3. Yields up again, really at that very important, significant 148 level. Just like the yen, since they've been moving together in lockstep, it's overdone, but really not diverging. Kind of look at that momentum. But we could get a pullback. I think it's a pretty important thing that's happening if we sustain a breakout in yields and a breakout in the dollar over that where we are right now, 93.5. Okay. And I wanted to show this. So NASDAQ on Friday, I drew this line off just, simple trend line. I just used these 2 lows. I didn't know whether the pullback it was going to turn into a reliable line. But then Friday, we opened right down here on the trend line and had a hell of a rally Friday, right? And then I guess last night we tried the 61.8 level. And I have to believe in this line for now, and we're breaking it. Okay. So I think that's significant. I'm not saying that it's going to, crash from here. In fact, the bulls would hope that we pull back, put in a higher low, and then rally again. But I keep hanging my hat on something that, I think is really significant because it's the largest market cap. And that's Apple. Okay, so I showed Apple at the 3 drive. I mean, this was take a picture. See that 3 drive on the weekly? And then we tried to recover last week like the whole market did. Okay, and to me, this looks like this could just turn out to be a failing rally. Yeah, tech does not like higher yields. You're right, DJ. The banks like it. The banks have been acting good, cyclical stocks, and then your mega cap tech really does not like higher yields. Maybe it has something to do with it makes their valuations look crazy. Anyway, this looks like a failing rally to me in Apple. And, there's some other stocks that don't look great. Amazon, broke weeks ago. Is it going to try the gap again? I don't know. And Microsoft has been the king, right? And, we'll see what it does today, but we actually had a divergence here because they took out the high by 1 penny and cleaned out the stops. Do not put your stops just above a swing high or swing low. Who wants to promise that to me today? Especially those that do that. They put it right over like a pip or 2 pips over a swing high and swing low. Don't do that. Everyone does that. Give it more tolerance so you're not a victim of stop hunts. Okay, you have to let your trades breathe, and the way you let your trades breathe is by having a stop that lets your trade breathe. Anyone going to promise they're not going to put stops right at swing high, swing lows for the rest of their trading career? All right, if you're, embarrassed and you don't want to talk about it, then just say it to yourself. You're not going to do that anymore. Stop hunts still happen. So then I look at Google. It could be a failing rally in Google. So I'm looking at the fangs, and I already showed you Apple. Look at Facebook. I know it came back, but it looks like a broken stock to me, So, most of the fangs, here's Netflix. It's one of the stronger ones, it's got a confirmed high. I don't know why. Are we going to be back inside watching movies? And that's about it. So really the key thing that makes me bearish the NASDAQ is Apple was the last to stage a rally this year. It peaked on a rising wedge. It's broken down. It could be just a little failing rally we get here. And I think that there's much lower numbers. Facebook looks bearish too, doesn't it? Yeah. So here's the weekly on, I don't know why we can't pull back to, over the next matter of months to $90 in Apple. That's a big trade.
So the question is, and good morning, Dale. And so the question is, with yields going up like this, how's the dollar going to react?
It is the question. And I know that you have held a bullish view of the dollar, Blake, where, everyone's I would thought that we might have some type of 3-drive top up here, but kind of looks like it wants to accelerate and break out here. So if we do close over this 93.5, why don't you grab the charts, buddy, and tell us where you think the Dixie's going if we break out here.
Sure thing. And I guess, the first chart, I was just pulling up yields as you were discussing it. And you're exactly right. The outperformance right now of the cyclicals is, it's obvious, right? The Dow's up, at least it was. Let me see where the Dow's at right now. But Dow futures are up this morning, where you got the they're up, but basically around 30 or so. Well, my Dow futures have about 68. Hold on, let me just double check my numbers here. 64 right now on the futures. But you can see that the S&P is a little weaker, and the S&P is turning, but most importantly is the NASDAQ, and the NASDAQ's turning pretty aggressively. And as you mentioned, on, about Apple and some of the tech stocks, they're definitely going to be influenced by the rise in yield. So one of the charts that I showed everybody, the very first chart on the week ahead video this week was the 10-year. And the one thing that I wanted to just reiterate here, if you didn't listen to the week ahead video, is that, on a break below these lows in bonds, that means yields are rallying to places that we haven't seen since pre-COVID. Because if you look at the COVID move, that this is the COVID spike higher, right? That was in February. We're basically going to be trading at those levels shortly, it seems like. And so, I mean, if the bond market and yields are going back to pre-COVID levels, think about what that reset means for everything else. Right, Dale?
Things that have not pulled back, that are still up near the levels they were in July and September of last year.
Exactly. So that's exactly right. So it's just something that I think that everybody's got to be, just strongly thinking about. Okay, where were things pre-COVID? And this is the market telling you that we're normalizing, and the Fed is, it has to normalize rates along with that. So if you think, oh, well, and I'm not going to sit here and tell you, oh, stocks are up at these levels and we're going to see pre-COVID levels. So we're going to see back here at
how did you know my target?
But I really don't believe that we're going back to those levels, because if you think about all the money that's been fed into the system, to push us along. Now, I wouldn't be surprised if we corrected towards the 200-day moving average, at least to start, which is at 4,100 in the S&P. But, could we get further than that? Could we go to 4,000? Sure. But just remember, the Fed's acting or going to be acting like the world is coming back to normal. Yeah. That doesn't mean that the stock market's going to give back all of those gains, because there has been an excess of liquidity that's been pushed into the markets globally, right?
Why the blue dotted line there, Blake? Is that like a demand zone or something?
That was a major breakout point. That was a major breakout point, because that was we had the AB equals CD, right? So you can actually see this. Let me reset that, and there we go.
Because I know some people that talk about that being a potential target, that 3,500.
Well, AB equals CD, right? And then we had it. That was our target initially back then, and I a lot of these things I don't delete. Then we had another AB equals CD target. Yeah. Then that held once, twice. Then, finally got a breakout. And so I think
that was the election.
Look at it was. Data. Yeah. It was the election. Yeah. And I guess that's why it was such a big deal. That all coincided around the same thing. Yeah. I was just looking, that is November. So
time flies.
No, but if you think about that, that's the Biden election, right?
Yeah.
And
the rest is, the Fed and stimulus checks and everything else to keep everything afloat, and injected all that money and buying mortgage-backed securities, even though we have a housing shortage.
I mean, and the market's up roughly. It shows 29% there to the highs, but let's just say, basically 25%, and there was a lot of fear that, the markets were going to turn lower as, Donald Trump was, is out of office. The market's going to turn lower because of that. It just goes to show you, really, the market doesn't care who is president. I'm a very, very firm believer, and always have been, that it's very cyclical in the markets, and Obama being around when we hit rock bottom. I mean, that's just it's just pure luck, right? So I mean, I'm not one of those people that say, because of unless there was like some big, event.
I think if Bernie Sanders was president, the markets would care more.
Then I think if you have somebody so extreme where it changes, then there might be, but yeah, that would be true. We would probably go down pretty quick as a result. So, but hey, Stelios, good morning.
Good morning, everybody, and have a
Morning,
good week
chaps.
ahead. Hey, Ryan.
Hey, Ryan, how are you doing?
Yeah, all good, all good. You?
Good. You didn't get electrocuted. That's good.
Yeah, always a bonus.
It's interesting. I'm kind of faced with the same issue here. I've got my garbage disposal, and I can hear it humming, but it's not spinning. And I'm like, man, I know there's something stuck in there somewhere, and I've got to rip the whole damn thing out. And I'm like, I'm just trying to, I'm like gonna unplug
Trying to put it off
and do all this like stuff to it. And I'm like, yeah, my problem is I tear things apart and then I can't figure out how to put it back together. So
yeah, I'm the same. I'm good at smashing things up, not putting them back together.
Exactly. I'm
I
not
can't even
like the
take
most
them
handy
apart.
person. What's that?
I can't even take them apart.
Oh, well, I mean, it's easy. Just grab a screwdriver and just start going to town,
Yeah.
just putting it all
What's a
back together.
screwdriver?
Anyway, so what's going on over there? Now, we were just talking about yields and stocks and, the market, taking notice of this rally in yields and, talking about like the 10-year, here's your 10-year bond market. I mean, we're approaching levels that we have not seen since earlier this year, and you can see this is the COVID move higher in bonds. So we're about ready to retrace all the bond market move. NASDAQ stocks are heavy. S&P is pretty heavy too. The Dow's positive as cyclicals outperform, but we don't know how long that's going to last. What do you guys think is going to happen here as equities move lower? Any ideas?
I've got a question for you guys.
Yeah.
And one that I put in a room and I've put out on Twitter. Just looking at the CFTC reports, the COP reports, futures positioning, and I'll look at the 10-year bonds just to see what's going on and what's happening. And my question has been, we've seen the open interest drop from the 7th of September report at nearly 4 million down to 1.4 million at last week's report. And this is a drop in positions across the board. So, for example, asset managers were long, nearly 1.5 million, short 1.3.5 million, 7th September. Now they're long 436,000 on one side and short 527,000. That's a big drop in overall positioning. And I'm wondering if we're seeing a move out of bonds, out of the safety trade, if you like. And my question is, where's the money going? Is it going into stocks? Is it going into risk? Is it going, other assets, ETFs? Where's the money? Are we actually seeing, for once, now the taper's on board? We've got the details. Are we seeing a move out of the general safety trade that is bonds?
Let me just answer one thing that might be part of the picture is, talking to Dale's buddy Jim Welch from Macrotides. He's been talking about the last couple of weeks about the bond market supply building right now. So maybe that's part of it. It's if people know that there's some treasuries, the buyer of last resort, which meaning being the U.S. is going to be buying less. Excuse me.
And we all know China stopped buying quite some time ago, I believe, didn't they? Everyone thought that was going to be
and I mean that there's going to be less demand, which maybe the bond market, that's what's reflecting it, right? And with yields going higher, and maybe there's other, the positioning getting a little bit more skewed because people are like, well, I'm not stepping into that. Not if there's going to be more supply coming around. So, and did you say positioning in general, Ryan, or
yes? So if you're looking at 10 years, the overall positioning, so it's longs and shorts, open interest. On the 7th was nearly 4 million, and now as of last week or last Tuesday, it was 1.4 million.
They liquidated out.
The question is though, it's not the fact of being the safety trade, because both longs and shorts have been taken out. So net, it's pretty much the same. So money's being taken out, probably not for risk reasons, but for asset allocation reasons. Which
so
means
so Ryan's asking where do you think it's going?
Yeah,
Where's it going? Yeah.
Cash.
But it's not going into
everyone-
gold.
No, it's not.
Everyone forgets that they can keep some. They don't have to deploy everything.
Yeah.
But
then that tells the story itself. It's going into cash. It means that perhaps the market isn't too keen on the growth story, because otherwise you'd go into risk assets, wouldn't you? You go into stocks.
Yeah, and if you won't buy bonds and only sit in cash, that's even a more negative outlook.
Exactly.
And I mean
stagflation again.
But the short end is and I'm showing you here, like here's the 2 and the 5 and the 10. The short end of the curve is really moving higher. The 30-year hasn't really moved a whole lot. So what's that tell you with the short end moving? I mean,
yeah, that tells you where the rate story is, and no one's thinking that rates are going to be 5% out, and that's it. That's why the long end isn't moving so much.
Yeah.
But I mean, that's one thing I can't check is whether this bond move has gone to other parts of the curve, purely because I don't have the older reports to check that against the 2s, 5s, 30s, that sort of thing. But it was just literally a stark showing, a real big change in the numbers, in the open interest numbers, that just caught my eye.
Yeah, well, I think it's worth keeping an eye on. But I'm going to tell you where a lot of money is going right now. It's going into energy. Take a look at crude. I mean, crude is ripping higher, and we're going right into a pretty strong, what I consider a very strong resistance zone, because this is, if you look back in 2011, this is the continuous contract right here. It's a CFD, but it's Oanda's, but it is basically the continuous contract. It's a good way to look at it. We're getting back to levels that we haven't seen since 2011. There's 2018, and here we've knocked our head up against this previously in early July or June, excuse me. Yeah, it's July. And here we are, back at that resistance. And, in my opinion, it looks as if crude is going to break higher. I mean, I think we're going to be challenging 80 real soon. It seems like it to me, but it's not only crude, that story with, nat gas too. I mean, you look at nat gas, it's ripping back up towards its highs here. I had a conversation with Shy Girl, a week and a half ago. If you didn't catch that webinar or interview that I did, excuse me, and you can see, we really just held the breakout point. I mean, yeah, we dipped a little bit because that was just kind of shake any weak longs out. But look at nat gas. I mean, it's strong. So, this rally.
He saw the bottom in that many months ago. He was calling the bottom. I hope he stayed long.
Huh. Well, that's yeah. I don't know what Stu. I don't even know if Stu's here. I don't know.
You guys saw that Goldman Sachs up their forecast for year end for crude to $90.
No, I didn't see that.
They did it just a few minutes ago.
Oh, wow. Well, there you go. So
that's a sell signal then.
Yeah, it could be. It could be. So what's on your radar right now as far as currencies go? And because I'll tell you, equities look pretty weak. We have just by the way, if you haven't seen it, the dollar yen is at the 78% retracement. We're in that big channel range. I don't know if I really would want to change. I know yields are going higher right now, and that's one of the things that's pushing the dollar yen higher. But at what point, and still, as I mentioned this on on the week ahead video, that we talked about this, and you specifically had mentioned that with yields going higher, at some point stocks are going to start to take notice. What currencies are on your radar as a result? With yields going
Well, you have to, I think, first of all, I don't think yields are going high enough yet for equities to take notice. I think we have to break above those 175, the highs before in 10-year yield. You really have to break above that. And for me to really take interest, and I mean, the big number is really 2%. After that, I think there's going to be issues. And what will I be looking at? Well, I'll be looking at the risk-sensitive currencies like commodity currencies, like the yen. But at the moment, unfortunately, I'm not. I'm not convinced. I'm still waiting for a proper breakout. And yes, there's going to be intraday or intra-week opportunities, but that's not me. So
yeah, and I mean, we are seeing a move higher or a move lower rather, a move higher in the dollar against some of these emerging market currencies. You got the dollar Mexican peso that's stronger today. And, one that I've been long and I'm staying long here is the dollar South African Rand is this flag, continues to play out. So, and these emerging market currencies, maybe they are signaling, there are some rougher times to come in the equity markets. But Ryan, what are you looking at as far as currencies go?
Yeah, I'm keeping a close eye on dollar yen, pretty much for my long-term positions. But I'm finding today it's another big but on the horizon. We've got the yield move, we've got the dollar move, and particularly against the yen as well. It's doing its grinding thing. It's been up pretty much all week, slowly grinding all the way down from 109 last week. But we're right into this end of quarter period again. And that throws in just that risk that you don't know if this move is real or are we just seeing some end of month stuff. So I think once we get over the end of month, if we see it pull back and all this reverse, then once again we've seen the same old thing where we get an end of month move, end of quarter move, and then we're back in the same old game again. If we hold these moves, the yields, dollar yen, over the month end, then I'll start to believe that perhaps we've got something really building, and I think then we could be on for 112, maybe higher.
Okay. All right. Awesome. Well, just here in a couple minutes, we do have durable goods orders coming out, so it's something that we should be watching. I mean, there's some important data coming out this week, as far as I'm concerned. We have the durable goods orders today. We have also some the inflation PCE numbers at the end of the week, the ISM numbers at the end of the week. So there's some things that are going to be released, and I think today we need to pay attention to this durable goods order. So let's run over to, if you guys do not have Forex Analytics, I'm going to share with you this right now. If you go over to where it says calendar, right, you can pull up the data flash. Data flash is where it pushes out the data as it's breaking about as quick as Bloomberg. I think Bloomberg is I want to say it's overrated because it's not. That's what a lot of people use it for. That's what I used it for the last 5 years is just to get like kind of, when news would come out, just getting the data released that quick. But data flash comes out about the same time. So, it's a really useful tool, especially for those of you that trade news. So that'll be out here in just 1 second. Do you guys have any other comments before this news is released? And by the way, Dale, who's your interview this morning?
Thomas Malanen.
Okay, I did not see the unless we had a tweet that went out. I did not see our tweet today that regarding your interviews, unfortunately.
His
so
Twitter handle's at MT Malanen. So
got it. Okay.
I we exchange messages on today on Twitter. So
cool.
He'll be here.
Good. Yeah. All right. So Dale, Stelios, any other comments here for you guys?
I just want to say I'm going to fire the person who does the social media stuff. So I'll be back. No, nothing. Did we mention the German elections where the Social Democrats are actually going to take over, and it's going to be now coalition talks. Angela Merkel is out. I mean, she's done she's had a pretty good
Yeah,
stint.
hell of a run. Yeah.
Yeah. So it's getting a bit complicated there. Okay, let's have a look at the data. But yeah, there's going to be coalition talks now, and there's other parties like the Greens and the Free Democrats and the other
How
parties
the
that they
right
have.
wingers do, how the Nazis do.
They're I didn't see all the results, but I don't think they're going to be.
Durable goods orders
Durable-
1.8%. That's pretty. That's not a bad print. Haven't got their the core data hasn't come out yet.
0.5 on the core.
Oh, 1.5?
You're saying
Or no,
Oh,
0.2.
no effect.
Oh, well,
Oh, the
Okay.
capital goods. Sorry, the capital goods orders is 0.5. That's up again.
All right. Well, the dollar is
Kind of the same.
not really doing a whole lot. But you know what's weaker is stocks continue to grind lower. Here's the S&P. And we should probably be coming into some trend line support here. By the way, if you watch the week ahead video, I said there's going to be some selling interest between, the 44.60, 44.85. The overnight high, just I'm going to have to pat myself on the back here, was at 44.85. So
Nice.
I mean, when you call at the pip, I mean, come
Clean
on,
it up, man.
come on. I mean, that was pretty good. So I can't. I'm gonna have to pat my own back. I don't normally do that. But
You know
come
what?
on,
When that
pretty good.
happens, it even surprises me.
Yeah, I mean, it's hell. Yeah, exactly.
How
Anyway,
is it- how can that be? That
Richard said there is patting yourself on the back and then
in
spanking yourself.
disbelief. In
Well, no,
disbelief.
I can't say I haven't spanked myself before. Oh, I'm just kidding. All right, we got to get out of here. I'm done. I'm finished. It's
All right,
yours,
buddy.
Dale. All right.
Do well. Be safe, everyone. Thank you, Stel. Ryan.
Cheers,
Thanks
Coach.
for and Ryan, thanks for that input on the open interest here, and Stel. Always great to hear your voice and what you have to say in here, and just let me know when you start buying some more silver, okay, bro?
Yeah.
All right, let me know. I need some more to match my hair. All right, so Thomas, welcome back.
Thank you. Nice
How
to
are
be
you?
here again.
Yeah, good to hear your voice, and gosh, so much happens between the time you and I talk to each other, and you were right. You said that by the next time you were on, that there'd be a taper announcement, and there is. Market has weakened, equities have weakened over the last 3-4 weeks, tried to recover about 61.8 of its losses, and it's heading down again. So what's on your radar right now, buddy? And are you going to share your screen?
Yeah, I'm going to share my screen. Actually, I called for the tapering announcement at Jackson Hole. So I was partially right, because the ECB announced it in the 9th of September. But yeah, thank you for a kind word. They come.
Right.
So
My memory isn't as good as I delude myself that I think it is. So all right.
Yeah, okay, but I was close. So what
All
I'm
right.
gonna close enough, I would say.
All right.
Yeah, what I'm gonna
For
do now is
government work, anyway. Government work.
what we are currently looking at is this is our outlook for the month of September, which has not gone out yet. There's growth forecast and stuff like that. But what we are looking at now is shown in this. Oh, what is that?
Are you going to show how credit spreads have blown out in China?
No, actually, I'm not talking about credit spreads. I go to the economy where the problems come from.
Okay. All right.
So the thing is that the credit impulse in the global economy, which basically measures the change in bank lending with respect to GDP, has fallen off the cliff in recent weeks or recent months.
Yeah.
And they come from two sources. First, this is the cumulative aggregate finance in the real economy of China. And the line here is the one we are now on. And this is the line from past year. So China is deleveraging. And that's behind the problems with the Evergrande, for example.
Right.
So land prices in some places have collapsed for 50% year over year, 50.
Okay.
So from where Evergrande came, there will be more.
Yeah, the cockroach theory. There's more than
Yeah.
one. Let me ask you this, Thomas. Besides it being a financial event, it's almost strategic. I mean, it is self-inflicted. These are policies that are driving this deleveraging, not some type of financial accident that happened, and the fuse was lit intentionally, starting with going after CEOs and the multi-billionaires in China.
True. Yeah.
So let me ask you this: what is China's intention? And I don't think it's just control of their own people. I think that they're intentionally trying to begin or accelerate a credit crisis to take our markets down, because that's how they could hurt us financially. And their people are more used to austerity.
Yeah, that's true. But that's one angle on it. But
right.
the second one is which we have been discussing a lot with the people who study China, for example, in the Bank of Finland. And there is a fear. There's a historical kind of a law that China will go through some serious political crisis every 70 years. And the leaders in China know now that the massive, the economy is so indebted that it will implode at some point. And what they're trying to do is balance between the economy crashing and the economy going over the cliff. And what they are mortally afraid of, and we agree with many of the China scholars, is that if the economy crashes, there will be a rebellion, full rebellion, and they will lose their power. So they are doing everything they can to control the society as much as they can, and then they are trying to keep the economy from going out over the cliff. And that's why they're doing these deleveraging efforts. They're trying to.
So is it like a controlled demolition instead of letting the build? Okay, so they're trying to manage this deleveraging.
Which really they have created. They have created the massive problem, and they are trying to manage it.
Good luck.
Without everything collapsing. And I don't know. We haven't really analyzed.
They think they can manage their currency. Maybe they could do that. I don't think they could manage a credit crisis, a debt, major default.
No, they cannot. No, that's something. But they are trying to get the leveraging under control. That's the idea. That's our view now. So they have the domestic issues weigh now much more than an international or foreign issues. That's our view now.
Okay.
Right. But we'll see how it plays out. But our call for the Evergrande is that there will be a debt restructuring and possibly chopping the company to several pieces sold to either private or state-owned corporations. So no actual bankruptcy, but some kind of a debt restructuring. That's our call now.
Okay, well, the market might celebrate that.
It might, but it's the thing is that there are so massive number of leverage, developers and there's real estate, companies there. So we don't really know what will be the reaction of markets, actually, the bondholders, when they start to look at the macroeconomic figures which are deteriorating, and then they start to think, will my bonds be cut too, like the principal will it be cut? So we don't really know how they react. So that's the thing, and we don't think they are able to go the full bailout, because that would just show that keep on piling the risk and we will bail you out. So there has to be a punishment, but it's really difficult to say how will the Chinese economy and the Chinese bondholders really take on it. Let's remember that the real estate is about 30% of the GDP of China. and it's now collapsing. So it's taking with it a large chunk of these corporations, developers, and banks too. So it's
everyone's long real estate in China one way or
Yeah.
another.
yeah.
Let me ask you about this because people are kind of whistling past the graveyard about China.
Mhm.
And I remember back in 08, 09, they weren't as damaged by the recession. They didn't hold a lot of toxic paper.
No.
They were still growing. And back then, economists would say, well, China's going to is still an engine of growth that will help pull the rest of the world out of recession.
Mhm.
Now, whether it was the Fed and China helped, you can't have it both ways. So
No.
if they're 1/3 of the world's GDP
Mhm.
and they're going through this type of crisis where asset prices are collapsing 30 to 50%,
Yeah.
how about this? They used to say when America sneezed, the rest of the world caught pneumonia. So can we say if China has pneumonia, there's at least a sneeze coming from the US?
Yeah. Probably, most likely. But the thing is, like you mentioned, that they got away from the 2008, 2009 crisis. This is the reason why. They put on they drove a massive credit bonanza. So this is like, if you look at this, these are completely unsustainable. The debt is going to the moon, and the GDP is lagging. So this is how they have done it for the past, 10 years.
What do you think about the move in yields that we've had in the last week and a half?
Well, I think it's just a sign of things to come.
Okay.
If everybody starts to taper and the issuance of new credit in the global economy falls, well, you will have problems. And they probably start at the junk bond yields. And then, that's a sign of things to come. The only question is, can the central banks control that or not? So will they be able, will they stop it when they see what is starting to happen?
You mean, will they stop a taper or even start the taper?
Yeah.
And go back to QE? You think that's what's going to happen? Is that
the taper,
several months into it?
Yeah, but taper doesn't mean the end of QE. It just means
it doesn't.
Slowing down the purchases. That's what.
Right.
Yeah.
Right. So they'll never get to tightening, will they?
Never ever they will get to tightening. It will be a crash. Like they tried in 2018. They really tried to shrink the balance sheet, and we know how that ended.
Powell got spanked.
Okay.
Both Bernanke and Janet Yellen put him over their knee and said, you have to lower rates.
Yeah.
And he's been a good boy.
He's been a very good boy. And then
now he's on his way out. He's going to taper.
Yeah, probably so. But the other thing is that when people talk about the strength of the US economy, this is the credit impulse. It measures the annual change. Like I said, the annual change in the newly created money or credit, basically bank loans. Yeah. And it is collapsing now, as you can see.
We're almost back to 08, 09 levels. Wow.
Yeah, that's something that really caught my eye when there's about 3 hours ago, I calculated this and noticed that it's collapsing. And so the US economy is not so strong as they make us believe. And if the economy is slowing, credit impulse is slowing, asset markets at all-time high. So this is a really, really bad combination, actually.
Yeah.
So there you go. Yeah. I could show also a few other figures from other reports coming.
So tactically, are you surprised at the dollar's strength?
Here? No, because the dollar always, when there's.
I know you were a euro bear a long time ago. Does that come back on the table?
Yeah, it is. It actually is. So the thing is that I could show a few figures on that.
Yeah, go ahead.
So this is the.
I wait 3 months to see your stuff, so I'll just shut up for a while.
Okay, well, this is our quarterly report. It's coming up to a week.
It is. All right, go ahead, bro.
Yeah, I will. And they let me see what's it. Yeah, this is the government debt to GDP ratios in the Eurozone.
I don't see it. You'd probably have to do a new
Okay.
share if it was on a different
Yeah, okay,
screen.
I put it again.
All right.
Yeah.
How about gold's weakness during all of this?
I don't know. I don't know. That's really strange. We are just, the inflation is speaking. I don't know. We don't actually understand what's driving.
Maybe China's selling.
Could be some big, like, elephant selling. That's very, really possible.
Yeah.
But I think when I talk about the Eurozone, if you look at these are the government debt to GDP ratio. You see it now?
Yeah.
Yeah. So, and these, there's like Italy is here, the red one, and it came down only marginally.
Right.
Same in Portugal, all this, and now they are, heading up really fast. Like Greece, it's back over 200% of GDP, about 220 at the moment.
It's worse than it was during their crisis.
Worst. So this is the Eurozone is at worst. Yeah, the crisis was here. It was here. This one, this piece is the crisis.
Wow.
Yeah. Just think about it. Now we're there.
So if the DAX ever takes a 20-30% hit, Europe's in trouble.
Yeah. And if you just think about these levels, these debt levels, what happened when now the ECB is, because the ECB, there's only one thing in the ECB's mandate, and it's price stability. There's nothing else, basically. So it's all that, and it's the price stability is tied to the, it said something that price stability is the best driver for the overall economic growth or something like that. But it's all about price stability. So when the price is rising like they're rising really fast in Germany now, like producer prices over 12%, 11%.
Natural gas. How about you guys? You paying more for energy?
No, we don't really use gas so much, and we have Russia. We get cheap stuff from there.
Okay.
And we have
Russia's going to have more leverage this winter than many winters prior.
Yep, they are gonna have it. Yeah, they can if they want to turn nasty now they can. Now they can, because the Europe is really in trouble. But just now the ECB tapers, and these massive debt levels, the yields will start to rise. So I don't think there is very many investors who wanna lend to Italy for 10 years with the rate of 0.7%. I don't think there are any such people here, for example.
Who's doing it?
The ECB. It has been buying the whole net issuance, and when you buy from the bond,
so they've been doing what the Fed has been doing.
Yeah, but in a larger scale even. So I think we have the balance sheets here, and these are balance sheets of major central banks, and red is the ECB.
Yeah.
So that's close to $9,000 billion.
Wow.
Yeah. These are not and it's, I don't know. I'm an economist. I just cannot understand that all this. Okay, I understand what they try to do, but this cannot end well. In no way.
When I look at that, I look at China, they've been more disciplined.
Yeah, they've been. The People's Bank of China has been, but if we look at let's see where it is.
So what do you do tactically here? Say finally a lot of the things that people were worried about start to manifest.
Yeah, I would buy gold now when it's cheap.
Buy it now.
Yeah, and hold the US dollar at least as long as before before the crisis really hits US. Okay,
so for a while, US will be a safe haven. That's why they'll buy dollars.
And I would be extremely careful of holding a large long position in euros, because this is not stable. Euro is not stable at the moment.
Okay, are there any other fiats besides the dollar you like? Aussie?
Swiss franc.
Okay, Swiss, yeah. Okay.
Yeah, so the classical, the very classic.
You're a gnome. You don't live there, but you're a gnome.
Yeah.
You know what a gnome is?
And actually, now I started to think, no.
It's I don't know. They're from Switzerland.
GNOME.
Yeah, GNOME.
Yeah.
a no.
Yeah. Oh, yeah. Okay. Yeah.
Yeah.
Okay. I might be.
Only you live in a different country.
Yeah, I do.
Yeah.
But the thing here is, if you come back to China, here is the share of non-financial sector credit to GDP or debt to GDP. Basically, this is all institution except excluding the government. China's here.
Wow, 230 compared to we're
Yeah.
at 150, 160.
And you know where Japan was when they had the major financial crisis? What was the level then? It was about 210.
When who had the crisis?
Japan in the early 1990s.
Oh, okay, 89,
Yeah,
way back
Yeah.
then.
yeah.
Okay,
So-
where the emperor's palace was worth more than all of New York real
Yeah.
estate.
Basically, yeah,
Okay.
it's an
Yeah.
insane bubble. And they had
Yeah.
like 211 or 210% share of non-financial sector credit to GDP.
So what do
And
you
now-
think this takes? It's starting now and, you know, probably intensifies into the spring,
Yeah, into the fall, actually into the Christmas, I think.
into Christmas, huh?
Yeah.
Okay.
So it will get worse. But this is the thing that China has to cut this. You know, they cannot. This cannot grow very further anymore. It becomes impossible to control anyway. So that's
And that's with their markets being under pressure.
yeah, that's the reason.
Yeah.
The
Okay, the
deleveraging.
FXI.
Yeah.
And what is it? Did credit spreads really blow out from in China up to like 14%?
Yeah, they did.
Is that
And
the
that's
highest
the-
reading you've seen in
I don't
your
know.
career?
Well,
I mean, it looks like-
2008, there were some really crazy figures too, but these
Okay.
have been big. So
Okay.
the same thing. So China is teetering on the edge of a financial crisis, that's for sure.
Yeah.
But it's-
Engineered.
Engineered, but they engineered they created it, and then
Yeah.
they try to but it's
How they're
engineered.
trying to
Yeah.
manage it.
Yeah. So, but it's we're coming a really interesting point here globally. Really, this is like we're heading to deep in the unknown now. And if you think how this compares to for like 1929, the great crash, there are like several similarities, starting from the massive use of leverage before, then the kind of the Fed tightening and the economy slowing. So the question is now what it will take for the investors to lose faith. And I don't think it's much. I don't know.
Yeah. Well, we're the tincture of time, Thomas.
Yeah, that's true. And one more interesting thing about China is this is global private non-financial debt, basically all new money, in the world, because money is created from bank loans.
Right.
So, and the blue line is the total with China, global debts total, and the red line is total without China. So China has created, if you calculate the difference, China has created about 60% of all new money created since 2009.
And they want to be a reserve currency.
I don't know what they want to be, but this is China has dominated the world economy. That is the point here.
Okay. I say we ought to have a conference in Taiwan soon so we could, have a front seat.
Yeah. Yeah,
Anyway, bud.
definitely. Yeah. Front seat for many things, I guess. but-
Yeah. So, thank you for showing some eye-popping charts today, buddy.
Thanks. Yeah.
Really, really some things that, and I thought you might go and talk. I've been talking about China. I'm pretty convinced after the last year and a half that besides trying to manage a crisis, they're also looking at the fallout could weaken other countries that are adversarial to them. Just my
They know
opinion.
they know it will happen, but the risk is that they are I think they're calculating the risk that can they manage to slow down enough. What happens, because there are internal risks,
Yeah.
like the political balance, and there's all those.
Well, I
two.
mean, that's why they stocked up. Someone told me they have 50 to 60% of all the above ground grain supplies stockpiled.
Yep. Yeah.
Right.
So because
Anyway.
you get revolutions when people get hungry.
Yeah. I get
that-
crabby.
Yeah, okay. Maybe
I've
you're not
got-
the, yeah, you're
I've
not the
gotta
rebel
admit,
35 then, I guess.
I get that, yeah, hypoglycemic. I get that low blood sugar. Stay away from me, man.
Yeah.
Anyway, Thomas, it was fun and compelling hanging out with you this morning. Thanks a lot.
Yeah, nice to be here.
And we'll catch up again at our next quarterly report.
Yeah, we could have another one like in December. Then we know what has happened.
Okay.
Yeah.
I think I have Dee's book, but I'll get you in early Jan.
Okay. Yeah, that's fine. That's
Okay.
fine. But
right.
invest safely, because now we're getting in the really like
Yeah.
the choppy waters here. That's
Yeah.
that's the point here.
All right. Well, be safe, spread the word, help as many people get as prepared as you can be in an environment like this, and at least, preserve some of their financial assets anyway.
Yeah.
So thank you, buddy.
Thanks.
You're my trading warrior brother, Thomas Mallinen, and you could follow Thomas on Twitter at MT Mallinen, and your website address. Maybe he left. Okay. Well, you'll find it. It's on his Twitter handle. So everyone have a great day. Remember, don't just count your crises, count your blessings. And you never know if you have faith until you need it. Adios.